Is your homeownership journey as predictable as a fixed rate mortgage? Another potential rate hike is on the horizon in just a few weeks in September. It is now August 2022. And a lot of people are still asking, should I lock in? What happens if my payment goes up with my variable rate mortgage? There's a lot of worry and teeth gnashing happening. But I want to talk about what I consider to essentially be a hidden cost of fixed rate mortgages. And this to me is one of the best examples of why a mortgage and shopping for a mortgage and talking to a mortgage broker is never, ever, ever just about rate. The rate is only one aspect of your mortgage, and I would argue it's not even the most important one, and I'm going to explain why. So, life is variable. Fixed rate mortgages, not super flexible. Here's why. Did you know that about 6 out of 10 mortgage holders in Canada will break their mortgage at the 3 to 4 year mark? 6 out of 10 will break their mortgage at the 3 to 4 year mark. So if you sign on for a 5-year fixed and life happens as it does in an unpredictable way and you need to get out of Dodge and sell that house and you got to break the mortgage, you could be in for a shocker. You could be in for a shocker. And here's what I mean. When you sign up for a fixed rate mortgage, there is a commitment between you and the lender that says, Mr. Lender, we, the mortgage holders, the borrowers, are going to pay you this predictable rate for 5 years. And there's other terms and conditions in there, but that's one of the big ones. It's different than a variable or adjustable rate mortgage. It's fixed. So if you are one of those 6 out of 10 who has to break your mortgage early, and everybody says they're the exception. I practiced real estate for 10 years. Everyone always says, this is my dream home, or my kids are gonna live in this condo for 5 years until they finish their degree and get settled. Life changes. Work changes, family needs change, babies are born, divorces happen, people just want to take their chips off the table and get out of Dodge for all kinds of reasons, and they got to sell their house and break the mortgage. Here's where the shocker comes in. When you break the mortgage, generally speaking, on a fixed rate mortgage, you will pay a penalty. It's called a prepayment penalty, because what you're doing is you're paying off that mortgage sooner than you committed to, and the bank is losing all of that interest money that they would otherwise make from you, the borrower. So the penalty is 3 months interest, or what they call an interest rate differential, whichever is the greater of the two on a fixed rate mortgage. Now, in layman's terms, an interest rate differential goes like this, and I'm just going to use round numbers. You should always get the exact numbers from the lender, because there's all kinds of other terms, conditions, fees, charges that could be applicable, but round numbers, here's what that could look like. Let's say when you initially sign on for that mortgage, the rate you got was 5%, let's just say. In a declining interest rate environment, which many economists think will happen in the next couple of years, interest rates are going to go up a little bit as we cool inflation, and then they're going to start to come down. We could go into recession, that's for another video. So you sign on for a 5-year fixed mortgage, 5%. 3 years later, life happens, life changes, you did not plan for this, and interest rates have come down a little bit. In the bank's mind, when you break that mortgage, they're losing big bucks because they could have kept getting the 5% from you. Do you see what I'm getting at here? And this is what happens. You're going to pay the interest rate differential, not just 3 months interest, because the rates have gone down. So let's say they only dropped by 1%. So you went from 5% when you signed up. 3 years later, rates are now 4%. So 1% drop. Let's say the balance on your mortgage is $300,000. The interest rate differential is $6,000. 3 months interest would be $37.50, which would be more typical penalty for a variable rate mortgage, but you're on a fixed. So the bank's going to say you owe a $6,000 interest rate differential. Now, what if the rates had gone down by 2% since you signed on for that mortgage 3 years ago? Well, now the interest rate differential is $12,000. $12,000. So did that really safe, great fixed rate product save you money? I don't know. Do you see what I mean there? $12,000, and the numbers just go up from there depending on your market and how big of a mortgage you've got. So this is where people get into trouble. The fixed rate can sound safe. What do banks always post and market? The big banks always post their 5-year fixed. Why do they do that? Because that's the most profitable product for them. Variable rate mortgages aren't generally the most profitable product for the banks. But in a changing interest rate environment where rates are going up, people start to feel nervous. And for some people, a fixed rate mortgage is the right product, but it really depends on your individual circumstances, and you need to be looking out into the future. How unpredictable is your life? For young people, maybe they don't know where they're going to be in 3 to 5 years. Maybe they don't know how big their family's going to be. Are you going to have a baby? Are you going to have 2 babies? Are you going to have a different job? Are you someone who gets job transfers every few years? You may not necessarily be porting the mortgage to another property wherever you move to. Life is not predictable no matter how much people want it to be. We don't like change. But I can tell you as a realtor, when I practiced as a realtor for 10 years, home buyers would buy a property and they would almost always say, I'm going to live here forever. Well, we hope they're going to live there for a really long time, but it often doesn't work out that way, despite your best laid plans. So, interest rate differential versus 3 months interest. The payout penalties can be really steep if you get charged the interest rate differential in a declining interest rate environment. I hope that makes sense. Please call or text if you have any questions, 403-382-7335, or you can look me up at karriflatla.com. Remember to follow me here on Facebook and YouTube. In the meantime, have a terrific weekend, and we'll see you for next Friday Fire. Take care.